What other requirements have I?
Every little time, you're like, this is what you look, the next time it's like, this is what you need to look up. And
I'm
then
just giving you, I'm just
on
giving you
Tuesday,
hints. No,
on Tuesday,
I'm
this
just,
is what you need to look up.
I'm just trying to give you some hints about the things that will make your paper better. How's that? So it's not really a requirement, yeah, Colin says. It's just hints, hints about what can make your paper better, things you ought to look for, you know. And again, I remind you, don't neglect the obvious. In other words, you're gonna make a recommendation. You might have some oddball things, the 4.7 billion or whatever, it was that Procter and Gamble, I can't remember. You know, you might have some oddball things. That probably doesn't, depending on the explanation, that may or may not detract then from your ultimate recommendation to buy or sell or hold perhaps that security. So, you know, that's probably gonna come from a lot of the basics. I mean, steady growth, great growth, improvement in gross margins, improvement in operating expenses. Those types of things are the things that should lead you to your recommendation. The oddball things are just things that you kind of go, what is that? We need to explain that away so that it doesn't detract necessarily from your recommendation. Does that make sense? Oh, no, absolutely not. Like I say, you don't neglect the obvious. Yeah, yeah. I mean, you gotta tell me, is the company growing? Are their gross margins getting better? How are they doing on their operating expenses? Are they buying back a lot of stock? Is their cash improving? Is their debt improving? Those are just the obvious things that we need to look for, okay? Yeah, it's like I've said, I think Costco might be one of the more boring ones because I've looked at Costco a lot of times, and they're just steady Eddie. I mean, you hardly ever find anything in Costco that really deviates from their norm, steady growth, steady this, their gross margins 13% period, for the last 20 years, and things like that. It would be difficult to, other than writing about the steady Eddie, which we all need to write about, in our own, in your own papers. You need to tell me about, because those are the things that are gonna lead you to make your decision, right? It's not gonna be the oddball thing, probably, unless the oddball thing happened last quarter or, last year that really adversely affected, the company, right? So I hope all that makes sense somewhat. Yeah, and I don't want you to get into the minutia either. In other words, Procter and Gamble's a huge company. If they had a $200 million write-off last year for some reason or another, it's like, that'd be like you and I buying a candy bar, I mean, it's nothing to them, right? Okay, and so that's kind of the minutia that you don't have time for that, in five-page paper. So focus on the obvious, focus on the normal things that we need to focus on, the income statement, the balance sheet, the cash flows, the equity, focus on those things. But as you're doing that, yeah, if you find some things that might need an explanation, yeah, their income statement's been good, except in 2018, they had a $4.7 billion impairment of goodwill because, boom, done. Okay, then we move on. Yeah, Walt Disney, of course, they just changed CEOs, went back to their former CEO, got rid of the one that had been doing it.
They tanked, the
And,
earnings will absolutely tank.
yeah, and they
They
invested,
spent like more than $100 million.
yeah, I thought it might even been over 200 or something crazy for that movie, and it just absolutely tanked, so, yeah,
It's the subject matter, okay.
yeah, maybe,
Seems to be a
yeah,
problem.
yeah. And I don't know if I'm not sure how that's booked. That would be interesting to see, if they book that as a goodwill because, they've created this, the expense that goes into it would just be expense, I would think. Some of those might,
Right, the actual dollars to make the movie
right,
minus the dollars that the movie brought in
right,
would be the expense, but
right. Yeah, but you can't write off goodwill that's not on the books as goodwill already. In other words, just because their reputation has decreased doesn't mean that there's a goodwill impairment. Yeah. No, a goodwill impairment has to come because you bought, let's say, they bought the rights to that movie, okay, and the book value of the movie was 10 million, but the movie, they bought it for 100 million. Okay, it would have 90 million of goodwill. The movie's not doing so well, then they could write off that, okay? But just a pure loss in reputation doesn't necessarily mean that you write off goodwill, unless it's already on your books, okay? So let's talk about capital markets. I find this stuff kind of interesting, especially with some of the stuff that's going on today, so. And I got some funny slides in here on occasion too, so. Oops, hang on, I don't think yeah, I did hit record, I am recording, so, okay. Economists get a bunch of crap, and rightfully so. They say in the real world that there's only two professions where you can get paid for being consistently wrong, and that's weathermen and economists. So I would say the weather reporters are actually improving their trade, though, because technology has allowed them to improve their chances of success. Economists aren't quite the same, so. Okay, what's the acronyms for the two major U.S. stock exchanges? Got one right, the NASDAQ. Do you like peppermint patties? What's the other one? You got the NASDAQ and you got, oh. Man, that was a pretty good shot. That went right between the computer and the monitor. No. And it was right between his computer and his monitor. I didn't get enough arc on it, so. Yeah, the NASDAQ and the NYSE, we all know that NYSE stands for New York Stock Exchange. Anybody know what NASDAQ stands for? It's kind of, you'll never guess it. It's a National Association of Security Dealers Automated Quotients. Yeah, yeah. Then, well, we'll talk about the NASDAQ. I think it comes up a little bit later. I'll tell you about it somewhat. So, what government agency regulates the securities industry? What government agency regulates the securities industry? He's gonna get it. I guess I get to keep the candy there myself. So, all right. The SEC, right? Securities and Exchange Commission. Okay. Yeah, the SEC, Securities and Exchange Commission. So, short-term markets comprised of securities with maturities of 1 year or less are called. Huh? They're called money markets. Okay, they're called money markets. If they got a maturity of 1 year or less, they're called money markets. Ooh, here's one. What's the common name for the Chinese currency? You're close. That's the Japanese currency is yen. But the Chinese. There you go. Yuan. Yuan. Yep, it's the yuan. That's the common name. Yeah. I think the real name is like renminbi or something like that is the actual name of their currency, but everybody calls it the yuan. Rate paid on the last dollar of income is called so if you were paying a tax rate, say on the last dollar of income, what do we call that? It's kind of an important concept. That's called the marginal rate. Okay, it's called the marginal rate. And that is kind of an important concept to know. If you're figuring your tax rate, people talk about jumping up to the next tax bracket. If you jump up to the next tax bracket, that doesn't mean that all your income's taxed at that rate, right? Because if in the way our tax is set up, it's a progressive tax system. So the first 20,000's taxed at 0, the next 20,000's taxed at 15%, and the next everything above that's taxed at 28%. That's wrong. I'm just making up numbers. Okay, so that means that anything after 40,000, every dollar that you make at that is taxed at 28%, and that's your marginal rate then, okay? It's that rate that you're paying on that last dollar, not necessarily on the first dollar, okay? Long-term markets consisting of securities having maturities greater than 1 year. Equities and bonds are maybe a part of this market, but there's a name. Yeah, making some good guesses, but they're called capital markets. Capital markets are longer-term markets when we look at things like that, when we look at bonds that have over a year maturity, or equities are generally considered in the capital market. They don't really have a maturity. Common stock doesn't have a maturity. Preferred stock does. But, common stock does not have a maturity. So, primary advantage of investing in municipal bonds. You guys had this as a part of your assignment. Come on, JJ. Primary advantage of investing in municipal bonds. Colin? That's not the primary advantage. You're right on target there pretty much. So yeah, the income from them is tax-free, so. Oh, better catch. Wasn't even as good a throw. I gotta be a little off target with you. If I hit you right in the hands, it's not good, so that's why you're a wrestler and not a football player, right? Yeti, this has been a while, a couple of years ago, I think, but Yeti in October, and for the first time, Yeti makes those nice coolers and things like that, made its stock available for anyone to purchase. This is called an, or A or N, IPO, yeah. I was looking at my candy jar thinking it was a little too full yet. I only got another week to get it down, so. I know, but I've been taking some home already. Least used of all long-term securities since the dividend is not tax deductible to the corporation. This one's gonna be hard. I don't know if these are gonna. Yeah. I thought they might float a little bit, yeah. The M&Ms. Now, don't blame me if you're overweight, Colin. No, I won't. Okay. You're 3 over, and you're not worried about it? That's like nothing. The kid on our team was like. That's why you don't do that too. So like. Big deal. Okay. The security trades in appropriate markets, not original offering, and it kind of goes with the next one. That's why I got them together. Provides liquidity to investors and keeps the prices competitive. Kind of right, but not, I mean. Yeah, basically. It's the same answer. How's that? Different questions, but the same answer. It's called the secondary market. Okay. So Yeti had an IPO, right? So when it went public, that was brand new stock that it issued out there. That's the primary market. Yeah, and so that's a primary market. But then after Yeti has its primary market, then Colin bought some when it was first issued, right? JJ's going to buy some from Colin later, a year later, then that's the secondary market, right? And you do that through an exchange like the New York Stock Exchange or the NASDAQ or whatever the case may be. Excuse me, right? Okay, when a company purchases its own stock with an availability of surplus cash. And again, this is something you guys should all be looking at for your companies because it's become a pretty big deal the last 5. Yeah, it's treasury stock. I was gonna say, yeah, you can answer on behalf of JJ back there. Oh man, well, that was a rocket I sent back there. I knew I had to get a lot on it to get it to the back of the room, so. Yeah, so those are all things, stock market, and that's kind of important. It's kind of fun to follow. It's something that you guys, especially you youngsters, should be really interested in because you're probably going to have 401ks or 403bs or IRAs or Roth IRAs, You should, okay, you absolutely should. I've threatened students in the past that if your company offers you a 401k and you don't take full advantage of it, I'm gonna come back and haunt you, okay? Because there's no better gift, that the government has given us at this point in time than 401ks, 403bs, IRAs, those types of things. If you're working for a company that doesn't offer that, then you need to take advantage of either traditional IRA or Roth IRA. That kind of depends on your tax brackets and stuff, okay? So when you do that, that's why it's important to kind of follow. If you go back and you look at the performance of the stock market over time, it averages about anywhere from 8 to 10%, okay, per year, annual growth, okay? Now, I'll give you a quick here's a quick thing that's kind of an interesting. Have you heard of the rule of 72? No idea, okay? The rule of 72 simply says you got to kind of keep decimal points out of this a little bit, but if you know the return of an investment, then you can know how many years it takes for it to double based on dividing that into 72. So if an investment's, and there's some real easy ones in here, like if an investment's earning 8%, it's going to double every 9 years, right? Because 8 times 9 is 72. If an investment's earning 6%, it's going to double every 12 years, because 6 times 12 is, okay? And vice versa. If an investment's earning 12%, it's going to double every 6 years, okay? One of the reasons Berkshire Hathaway's been so successful, his annual return since inception in 1956 or whenever it was has been 20%, okay? So that technically means if you had an investment with Berkshire Hathaway, your money would double about every 3.6 years. This gets a little less accurate as you get out to the extremes like that. Okay, so the doubling isn't quite as accurate when you get out there. When you get in that middle, that 7, 8, 9, 10, 11, 12 even, those are pretty accurate, And you can go, if you want to, you can go to Excel and put that in and figure it, and you'll see, how accurate that is. If we got some time, maybe we'll do that a little bit later. But yeah, so our markets are really, really important, and the fact that we have established markets kind of has given the U.S., for the last 100 years, maybe kind of a leg up on some of the other countries, because we freely trade, we can buy, sell, trade, do those types of things. That allows money to get to companies that need it for growth, et cetera, right? So it's huge. That said, if you remember your stories from, none of us remember from firsthand, but your stories from the crash of 1929, right? That was a stock market crash that supposedly led to the Great Depression, okay? And probably so. And so as a result, we saw Congress step in and start to regulate that. We're seeing something similar happen today. Have you guys been following FTX at all? Oh, JJ shaking his head. FTX, yeah, yeah, yeah. Yeah, well, it's yet to be seen what all, nefarious activities happen, but there probably were some. But anyhow, FTX, we've got crypto now, right? Cryptocurrencies, Bitcoin, those types of things. But how would you go about buying Bitcoin? I don't know, right? So some exchanges got set up. Yeah, cool. Anyhow, some exchanges got set up, and FTX was one of those exchanges, right, where you could buy and sell crypto, okay? And there's other ones out there, Binance or Binance or something like that, and Coinbase. There's a few others, And some of those are probably real legitimate. But this FTX, it turns out, was a fraud maybe from the word go, right? And so they were taking money and then supposedly holding on account, right? You'd send them money, and they supposedly are holding 2 Bitcoins for you, say, for example, right? Well, all of a sudden, people said, well, I want to sell my Bitcoin maybe and get my money out of there. So they called up FTX, and here just a couple of weeks ago, FTX said, sorry, but we don't have any money, okay? So that money that you sent us has been, well, a bunch of it was donated to political campaigns, and some of it was squandered on a penthouse in the Bahamas, and we don't know where else a lot of it went, okay? So guess what Congress is talking about? Now we got to regulate crypto, right? I'm a little bit, I'm like, if people are stupid enough to invest in that kind of stuff, then, you know, they ought to lose their money. But anyhow, we'll see.
It wouldn't be crypto anymore if it was getting government.
Yeah, I don't know if they would regulate the mechanisms of crypto, you know, the actual mining and whatnot of
Just like the services that you can purchase.
the exchanges, just like, you know, they regulate the New York Stock Exchange and they regulate the NASDAQ. And, you know, I'm a little government, small government kind of guy, but, you know, those regulations, I mean, that's why we have quarterly statements, because the SEC requires them, right? That's why you and I can read how a company's doing. Would that have happened on its own? Maybe, you know, because technology's made that pretty possible and whatnot. So it might have happened on its own, but the SEC's made that happen, and it makes, you know, annual reports look very similar, right? Doesn't matter which company you're looking at, because that's kind of the information that the SEC requires. And it gives us pretty good information. So you know, I'm always kind of in the middle on those things a little bit. So, but markets, yeah, markets are influenced by variables. What happened? Did you guys listen or watch the stock market at all yesterday? It was kind of fun. It started and it went down. I think it was down by over 300 points at one. The Dow Jones was down by over 300 points at one point, and it finished up over 700 points. So more than 1,000-point swing in one day. And why'd that happen? Because Jay Powell, who is the chairman of the Federal Reserve, made a statement. Okay, he was being interviewed or something, and he made a statement or having a press conference that, oh, I think we're not done raising rates yet, but certainly the pace of rate increases will be moderated. Okay, so they've been raising. They have several times raised interest rates by 0.75%, last 4 or 5 times. And now what he's saying is that, well, we'll probably raise rates again at the next meeting, but it's probably only going to be 0.5%, or maybe even just 0.25%. Boom, that got the market all excited, because rates and the stock market are kind of inversely correlated. Okay. Obviously, that has a lot to do with investor confidence. Economic growth hues. Also, the GDP came out, the revised third quarter GDP, and it was 2.9%. Which isn't too bad. But then you can have global crises like the war in Ukraine or all kinds of other things, the pandemic and all those other things that can certainly affect markets, right? Money markets, we talked about that. Treasury bills, okay, that are due within a year. Commercial paper, again, bonds and bonds or notes that corporations issue. Negotiable certificates of deposit, right? So you can go on, you know, obviously you can go down to your local bank and get certificates of deposit. You can go online and get them through companies like through Fidelity or Vanguard or, you know, D.A. Davidson, whatever. And, oh, yeah. They're negotiable in that, you know, I've been buying some for my mom in her account, some CDs, because I think rates are getting towards the top, and so I'm buying them, and some of them have a 1-year maturity. Well, 6 months from now, I could, on Fidelity is who she goes through in this case, I could sell those if I wanted to, right? There'd be somebody out there, an interested party, that would be interested in buying that from me. And just like bonds, I mean, they'd be priced just like bonds in that case. And so that's why we can kind of call them negotiable. Rates, I mean, you're right, you may or may not really be able to negotiate the rates, but you can negotiate the sale of them, right? And then we got capital markets, right? Bonds, common stock, preferred stock, convertible securities. They issue some bonds, right, sometimes that are convertible bonds, meaning that at a certain point in time, it'll turn into common stock. Okay? And preferred securities can do that maybe as well. Kind of rare. I don't see that very often. What's that? Maybe, yeah. Yeah, yep. They usually do those maybe in some special occasions. In the crisis of 2007, the Great Recession, 2007-8, you guys are too young, but Buffett, I think, he might have had some of those deals because he bailed out a couple of companies, or not himself personally, but Berkshire Hathaway. And I know he had some preferred stock, and some of that may have been convertible preferred, meaning that at a certain point in time it would convert to common stock. But I don't remember for sure if that was the case. Yeah, they were way too young to, yeah. Yeah. So, international capital markets, I mean, we've become a global society, like it or not. And part of that's trade. We had NAFTA, right, the North American Free Trade Agreement, which actually went away and was replaced by, Mercusa? Mexico, Canada, USA, something like that, that Trump negotiated and was signed. And so NAFTA's kind of gone away. CAFTA was the Central American Free Trading Agreement, and I think it is still maybe in place. WTO is the World Trade Organization. Euro, everybody understand what the euro is? Up until say 25 years ago in Europe, every country in Europe had its own currency. Okay, and right now, Great Britain, of course, Great Britain exited the euro, the European Union, and so it still has its own, but it had always kept its own currency, the pound. Okay, but the rest of Europe operates under one currency, and that's the euro. Okay, that kind of puts some restrictions on what the government, what their central bank or central banks can do in the individual countries. That's a semester worth of talking right there, maybe talking about central banks and what they can do and can't do. So NAFTA, WTO, yeah, euro cash now exceeds the value of dollars, and that's maybe now. We've put a lot of dollars in circulation in the last couple of years with all the stimulus and that kinds of stuff. So yeah. Yeah, a lot of concern about jobs going overseas, Mexico. A lot of them have gone down there. Car manufacturing's done in Mexico. Of course, a lot of stuff's made in China now. But I can, being an old person, I can tell you guys in the '80s, everybody was worried Japan was going to take over the world because they had the most modern and best manufacturing practices. I mean, honestly, you could go back and read stories from back then, and Japan was going to take over the world. And then they kind of maintained, and the rest of the world moved on beyond them, I guess is what I'd say. They still have a great living standard and everything in Japan, but they just haven't really progressed a lot since then. So, yeah, you got to be old. You got to be old to understand that. You don't remember who Ross Perot was? Oh no, they don't. They've never heard of Ross Perot. So, yeah. That's what you guys can access this one and kind of read through it. It's kind of funny a little bit. So, Montana is cooperative gun nuts. Yeah, well, we get along with each other. We don't shoot each other for the most part. So, this was in 2011, so it's a little bit dated, but trading volume, it's huge, right? And the NASDAQ has exceeded. The NASDAQ started, believe it or not, I told you I'd tell you a little bit about that, but at one time, New York Stock Exchange has some pretty stringent requirements if you want to be listed on there, some pretty stringent financial requirements. Well, there were a lot of companies that were up and coming that didn't meet those requirements, and so what happened was the security dealers, your stockbrokers, your Raymond James, D.A. Davidson, Edward Jones, those places, they kind of set up this little exchange where people could buy and sell those stocks, that didn't quite meet the stringent requirements of the New York Stock Exchange, okay? And so that kind of got started, and that kind of kept growing as more companies wanted to go public but couldn't meet the New York Stock Exchange requirements, okay? And then along came finally some companies like Microsoft is probably the first big one. It went public on the NASDAQ, okay? Well, and within 10 years then it became a huge, huge, huge company, right? One of the biggest in the world. And it was being traded on the NASDAQ and not on the New York Stock Exchange. And so you had a lot of other companies. If you look at ticker symbols, which you guys had that assignment, right? If you've got a ticker symbol, this is typically, it's not absolutely the case anymore, but if you see a ticker symbol that's got 4 letters in it, it's typically a NASDAQ-listed stock. So Apple is AAPL, right? Microsoft is MSFT. Procter & Gamble's PG. PG is listed on the New York Stock Exchange, I guarantee you. Now, do they get traded on the other exchanges too somewhat? Yeah. Okay. But that's where their initial listing takes place, okay, is on those particular exchanges. So, yeah. Companies can raise debt at the lowest, again, you know, Microsoft has a better, and so does J&J. There's 3 or 4 companies that are AAA in the world, that's it. But they have a better credit rating than the US government, right? And so they can, yeah, that seems good. Yeah. So they can raise money, right, in these capital markets, and they should be able to borrow money at cheaper rate than the US government can, believe it or not. Whether they can or not, I'm not sure. That's number one. Number two, Microsoft doesn't really need to borrow a lot of money because they got $80 billion of dollars. But they still do. I can go out and find you Microsoft bonds. I mean, they'll do that. They'll do that sometimes to buy back their stock just because they could, back when rates were extremely low, they could probably borrow money at 1.5%. Why would they spend their cash? They could borrow money like that and buy back their stock that's earning, you know, a return of 4, 5, 6%. You know, I mean, it's just crazy. Of course they did. So. Yeah.
That gives them the opportunity to pay themselves the 8%.
Yes, sort of. Sort of.
They get to keep their own money.
Yeah.
That's better.
No, but they can keep their money. They might use their money to buy another company. They might use their money to invest in some
Right,
other
instead of paying
investments.
me, which would be fine,
They,
all that is good.
no, not all debt's good. I agree, but you know, when you can,
If you need it to get around, cautiously okay with it.
yeah.
But if you just go get it to go,
In some sense, I don't disagree with you because my philosophy's always been, yeah, you know, don't borrow money unless it's to make money. Okay, and that might include buying a house because that may be cheaper than renting, for example, or at least you're going to build up some equity, some things like that. But But again, as a financial person, you could sit down there and if Microsoft wants to buy back stock, it makes financial sense for them to borrow money. Number one, because the interest is tax deductible, right? So while I say their interest rate's 1.5% or maybe 2%, whatever it is, they also get to deduct that interest. And so their actual cost of money becomes their effective rate, maybe 1% or, you know, 1.2% or something like that, okay? And yet they can have, if they've got that 80 billion, they might have that invested in things too that are returning 3, 4, 5%. Okay, so why would they cash in something that's earning them 3 or 4, 5% to buy back their stock when they can just borrow money to do it? You know, so yeah, those things get. I mean, it gets past the. You got to get past sometimes the philosophy. I don't disagree from a personal.
having lived hand to
Yeah,
mouth,
yeah, and from a personal
and not
financial.
living hands to mouth anymore.
Yeah. From a personal financial basis, I agree with you totally. But from a, you know, from a business standpoint, that's what we're worried about. This is business finance, so it is. It is. But leverage can create higher returns. You know, we did that with the return on equity thing, and be happy to show you that again. So, foreign investment, you guys had a question about that, right? It helps finance the national debt. You know, so got securities available in the capital market. Federal government, U.S. Treasuries, right? Government agencies, so they're separate agencies like Fannie Mae, Freddie Mac, Farm Home Loan, different things like that. State governments and local municipalities. So you can choose among corporate or incorporate, non-corporate securities with the desire to, right, risk return. FINRA's got kind of a neat site to look at bonds. Again, get a chance, maybe we'll take a look at that. So it manages the federal debt, the Treasury does, right, to balance the flow of funds, somewhat in conjunction with the Federal Reserve a little bit, right? What's that? No, they do a horrible job, okay? But that's because the government does a horrible job with most things that they do. And so, you know, they should have been, over the last several years, they should have been paying off all the short-term debt and getting debt that was long-term 30-year because you could borrow, because they could borrow money at 2%, let's say, right? Okay, but they keep this mix of short and long-term. You know, they're not very bright, and so a lot of that short-term stuff that they had at 1% maybe is now rolling over, and because rates are higher, they're gonna have to refinance that at 4 or 5%, and so, yeah, we're gonna end up paying, you know, the income statement for the government's gonna show a whole lot of debt payments on there, bigger debt payments in the future, so,
The kids' kids
yeah.
now have $20,000 of debt, and they're not even college.
I think it's around 95,000
That's for them,
per person,
that's for them.
yeah.
I'm talking about his kids' kids.
Well, they'll have even more than that then.
Right, but right now.
So like,
We all owe about,
that's like that because the country.
well, do the math, you got
Like
Excel there, we got 31 trillion divided by,
1 trillion now?
divided by 300 million people, right?
330.
Yeah, so that would give you about, probably about 95,000 then, I think, so, right? Yeah. So, some of these agencies, what they do is like the Fannie Mae, Freddie Mac, and Sallie Mae, okay, they sell bonds, right? Raise money so that they can finance house mortgages, those types of things. That's kind of what caused the crisis in 2007, 2008 that fortunately you guys didn't really have to live through. You might have heard your parents squealing about it a little bit, but farm credit, yeah, student loan, Sallie Mae, that's called, yeah, state and local, okay. Corporate bonds, again, we can kind of take a look at those. It's kind of fun because I look at them every now and then and I'll plug them in to see if I can get a value that's pretty close to what they show on here with using the bond equation that we use, right? And it does. It's not exact because I don't pin it down to the day. You know, I can only make some estimates on that kind of, so. And preferred stock just doesn't get used very much because the corporation doesn't get to deduct the dividends, right? Okay, so it's kind of a negative from that standpoint, and yet it gives the it's a real positive if you have a chance to buy some preferred bonds, or preferred stock, I'm sorry. That's a good thing from you as an investor standpoint. Usually they pay lower rates though, because it does give you as an investor a little bit of an advantage, but it's a disadvantage for the corporation to issue those. Again, sometimes the corporation does that on special things. I know that Buffett entered into some preferred stock things when he was bailing out some companies, Goldman Sachs being one, you know, back in the financial crisis. So he was issued some preferred stocks. So common stocks is stuff that we see. You know, that's the pricing that we see when we look at that. Treasury stocks, what the company buys back, right? Internally generated funds help. And you guys saw that typically it's external. That's probably in some of the more mid-sized and smaller corporations, because again, if we look at Apple, you know, they got $250 billion of cash on hand, okay? Do they still have some external funds? Yeah, the original issue of their stock, plus their retained earnings. Okay, that's the retained earnings is internal. The original issue of their stock, and they have some debt, that's their external. Okay, but for Apple, you know, it's probably 90% internal and maybe 10% external. But you get smaller corporations and they tend to have more external funding, especially a new company, right? I mean, virtually everything for a new company is going to be external funding, sale of stock and debt, right? They haven't got any retained earnings yet. And so that's why that leverage or that percentage is kind of goofed up a little bit. Depreciation's a tax shield, right? Helps retain cash and whatnot. But depreciation's a real expense. A lot of people don't think that, but you know, just think of your own car, right? Your car is gonna fail at some point in time. It goes down in value. Okay, you should be saving money to replace that when the time comes, right? Household, yeah. You guys didn't see this yesterday either at noon. You weren't watching Charles Payne on Fox Business, but you know, the savings rate has gone from, at one point during the pandemic, our savings rate was up around 33%, and it just, yep. Well, and when the government's sending you all kinds of money, you know, so the savings rate was up about 33%. It's down to 3.1% now. Conversely, credit card debt was at 2.5%. It's at like 17% right now. And so we've seen this huge change, and both of those are they were way out of whack from norms during the pandemic. They're a little bit out of whack from norms. I mean, normally people carry some credit card debt, And our savings, normal savings rate, I think 6 or 7%. So we're about half on that, and we're probably about double on the, okay? So those aren't good trends, actually, right now, so.
My kid closes on his house tomorrow.
For 760 square feet.
$760 town loan, so he's bringing like, borrowing on his main loan, like 300,000.
Yeah.
And I don't know why they did it, like, I don't understand what this is.
They oftentimes like that, that other
Because
loan
what
will,
the smaller loan, he's calling it the down payment.
right,
And
Right.
he's borrowing the down payment. I'm
Right.
like, oh my God.
right.
I don't even know.
And those sometimes go through like an insurance company almost or
Yeah.
whatever, and
And
so
they
it's
bill
a, is it PMI or something like that, primary mortgage insurance?
Yeah, well, he'll have that
And-
until he's 100.
Yeah, so, which kind of gets, I mean, that goes back to a little bit to the days of 2007 when there was no down, no doc. I mean, some of the crazy loans that were happening then were just nuts, so,
I'm like, I know you're crazy to get a house,
yeah,
in a house the size of his room,
yeah.
and now you're buying a house the size of his room, so.
Security markets, you guys kind of answered those, and, yeah, corporations, government wouldn't be able to without the markets. Changed, right? I mean, tech has changed everything. You guys ever watch the movie, I think it's Trading Places with, yeah, Eddie Murphy and Dan Aykroyd, right? Yeah, yeah, and they're, they show them down, and in this case, it's on a commodity exchange, which still kind of exists, I think, in Chicago, the CME maybe, Chicago Mercantile, where the people are down on the floor yelling and screaming and holding up papers and doing those types of things.
You have to look up this movie if you've not seen it, because
It's funny, Trading Places. It's a funny movie, but it kind of shows you how these exchanges worked 20 or 30 years ago. I mean, literally, people down on the floors were, they would get orders. I would call my broker. I'd call my buddy at Raymond James and say, I want to get 100 shares of Apple. And he'd put that order in to somebody that, from their company, that maybe had a seat on the exchange, or somebody else that was, they contracted with that had a seat on the exchange. That meant that they could literally go down on the floor, right? And they'd put up a thing that said, hey, I got somebody who wants to buy 100 shares of Apple and he's willing to pay X. And just yelling and screaming. So they had hand signals and that kind of stuff going on. I mean, literally, it was just crazy. Yeah. And that's how all these markets operated 30 years ago, say. Obviously, technology has completely changed that. Yeah. Now I call my buddy and I say, I want to buy 100 shares of Apple, and he plugs it into the computer and hits send, and it gets sent to the, and if there's somebody out there that wants to sell 100 shares of Apple for the price that I'm offering, it meets up and it happens, right? But in the old days, yeah, I mean, it was fun kind of just watching those guys do their thing down there, and yeah. If you watch some of the old movies, you'll see, yeah, yeah. Oh, yeah. Yeah, how they could, I think in the mercantile exchange, they often wore different suit colors and whatnot, so you would have a certain color and whatnot, so you would be recognizable as the person maybe that's on the mercantile, maybe trading wheat or trading a certain commodity maybe or something, okay? Or maybe for a different company, I'm not sure exactly, but they wore different, I mean, you'd see the same guy, he looked like he was wearing the same suit every day, I'm sure he had 20 of them, but it looked exactly the same so that he would be recognizable on the exchange. Yeah, I just, and it's amazing how efficient that was, right? But now, of course, it's even more efficient with the stuff, so. You don't see I mean, there's still a trading floor now, but it's just all computer monitors, and there's people up there kind of watching what's going on, and it used to be having a seat on the New York Stock Exchange was a huge deal because you could rent your services, right? Because you were one of the few people, they had a limit, maybe 100 people or a couple hundred, and there's a limit of the number of people that were on that. So you were basically renting your services, you know, because D.A. Davidson, they're a small little brokerage firm. They don't have a person that has a seat, but they could contract with somebody that was on the floor, right? And that person would make a little bit of money off that trade. Okay. The regional exchanges, there were some of those that were done and still are. CBOE maybe, Chicago Board of Exchange, something like that. So we won't get into too much of those. Yeah, New York Stock Exchange still has a little bit more stringent requirements, you know, than like the NASDAQ if you're going to go public. Again, that's probably why still newer companies will tend to maybe go public on the NASDAQ then and maybe not go to the New York Stock Exchange. I didn't write it. This guy Glassbergen. I emailed him one time. I asked him if it was okay if I used his slides in my presentations. He said no.
Really?
Yeah.
You said no?
He said no.
Oh.
He wanted me to pay him. And I'm using the fair use doctrine, which says that, no, I can probably use it as long as I'm not making any money at it and I'm using it for educational purposes, so, yeah. Well, we've got the electronic, right, ECNs or whatever, I don't even know what electronics, I'm not sure what the CN stands for, but, yeah, and it's just modernized everything, that's enough that you guys know, right? New York Stock Exchange has merged, it was acquired actually by the Intercontinental Exchange. So the New York Stock Exchange is actually owned by a foreign company, kind of like Budweiser is owned by InBev, right? Which is a foreign company. They both might be out of Holland too, I'm not sure. So ICE, Intercontinental Exchange, I think is sometimes called ICE if I'm not mistaken. So, yep. So NASDAQ, right? They never had that floor trading because, again, when it originally started, it was just brokers really calling each other and saying, or posting it to some place and saying, hey, I got 100 shares of, I got a customer that wants to sell 100 shares of Apple, you know, you got anybody interested in buying them at this price? And, you know, obviously then it became more and more advanced as things came along, so. Foreign exchanges, companies can be listed on foreign exchanges. Some of the big ones are, there's the Hang Seng, which is Hong Kong, the Nikkei, which is Japan, and can't remember what the European one is. Shoot, FTSE. No, FTSE is Financial Times. Yeah, FTSE, Financial Times Stock Exchange, I think. And then there's France one. There's, yeah, don't remember all of them. Anyhow, companies can be listed on multiple ones, right? Just like foreign companies. If you're looking at, remember at the start of this project, I said don't pick one like Toyota. You and I can buy stock in Toyota. That's not a problem, right? You'll see Toyota's listed, and it usually will have something behind it. ADR stands for Automated Depository Receipt. Okay, that's just telling you that that's a foreign stock that's being listed on an American exchange that you and I can purchase, not necessarily subject to the same, you know, stringent requirements that the SEC might impose. And that's kind of why I shy you away from that. We might not be able to get the information on those companies that we can get on an American company. So, okay. But there are a lot of foreign companies that trade. You know, we can buy Alibaba. We can buy, you know, even, you know, Chinese companies that are traded, and et cetera, et cetera. So there's just some examples. Futures. Okay, so now we also got things going on, and this was part of the problem with the financial crisis of 2007, 2008, was some of these derivatives and whatnot. I don't even understand derivatives. I can understand the options markets a little bit, but derivatives gets to be a little bit funky. It was described to me as buying insurance like on your neighbor's car and then going out and wrecking his car, you know, and so derivatives got to be a little bit funky, but they were part of the problem in that 2007, 2008 thing. Futures we all understand, right? Most of us live in an ag. We all live in this ag area, right? And I'll break it down, make it pretty simple. So if a farmer, he's going to raise a crop this next year, right? He may start to sell his crop in April. And I had a lot of customers that did that. They'd sell a portion of their crop. That's the futures market, basically. He's just betting that the market's better now than it's gonna be at harvest time, okay? And so
Well, but the future market is where I think the price, I buy
yeah, you can do
stock
that, yep,
in a crop, so I've
Yep.
got 100 bushels or whatever.
yep.
And then I'm going to sell it in May. I've already paid the money. It's like a bond. But I'm hoping it's gonna be $8 a bushel and it's only 7 now. I've lost. Try to explain it, cause he was doing it, he
Yeah.
lost his.
Oh, yeah. People that speculate in that, I occasionally had a customer that'd want to speculate in that, and I said, yeah, hedging is a perfectly good strategy. And but what's hedging? So let's say that same customer sells his crop in April, okay? Boom. So he sells, 100,000 bushels of wheat. It's going to be delivered in September, but he's selling it technically in April, right? Okay. Well, but he's sitting there, he gets on his tractor and he thinks, well, what if the price goes up? Okay, because it could. He's locked in. He has no downside now, right? His price will never go below, let's say, $10 a bushel. Never go below that because he's already sold it, right? He starts thinking, what if it goes up? Okay. Well, he could go in and hedge. He could go in then to this market and say, I'd like to buy a call, is what it would be, option on 100,000 bushels of grain, because that's what I'm going to have. That's what I'm estimating anyhow. And I'll buy it at either in the market, which would be the $10, but he might say, I'll just buy it out of the market. I'll buy an $11 one because that's a little cheaper, okay? Well, if the price gets up to $11, his option expires and no, he spent money and he lost it a little bit, but those options are pretty cheap. Might cost him 10 or 15 or 20 cents a bushel if it's out of the market, right? Okay, right. But if the price went up to 20 bucks, okay, because farmers are always worried about that, right? Then he's going to get that $9 difference with that call option. Okay, and so that's what hedging is, and that's a legitimate strategy. Okay, and I never had any problems with customers that were just hedging, just using, the markets to lock in a price, and then maybe protect that on the other side. Okay, does that make sense? It can get to be a little bit confusing. Okay, but you can do that with stocks though too. If I think that a stock's going to go way up, instead of buying the stock, I can buy an option in the stock. Okay, it's a lot cheaper to buy that option, but one thing to remember is that about 80% of options expire unused, meaning that I could buy that option, but there's an 80% chance it's going to expire and I'm out the money, right? But it's cheap. The 100 shares of Apple. Yeah, 100 shares of Apple right now, it costs $14,000. I could buy an option on 100 shares. If I want to get it out of the money a little bit, it might cost me 140 bucks, 150 bucks, 200 bucks, something, depending on how far out of the money I've got it. So it's an inexpensive way to play that market if you want to. But again, that's pure speculation, and I'm not into speculation.
You just have to kind of guess whether.
And you might have some legitimate reasons why you think that would be, a good thing.
So if you put a call on like 100 shares of Apple, you're not really in the price, but it's still,
Yeah.
I think it would.
Yeah.
Could you sell those 100 shares?
That's technically what you're doing. What
Or
you're
that-
actually,
You don't have it.
actually what you're doing is that when you buy a call, okay, you're buying a call, let's say it's in the money, okay? So I'm buying a call at Apple stock is 140 bucks right now, okay, and I want to buy it in the money. So I'm buying it at $140. What you're saying is that I'm going to buy Apple in the future at that $140, okay? So if Apple 6 months down the line is $180, you exercise your call. Technically,
So
you're
you buy it then, but then you could sell it.
you're buying it and selling it all at the same time,
That's
basically.
why
Yeah.
it's investing in.
Right. Right. Okay. Yeah. Well, it's basically the same thing with the corn and the wheat thing. So yeah. So that's basically, and then a put option is the opposite.
You can't just be like, oh, $100 to actually buy it, then you're calling.
Well, no, because because you're paying for that option at the front end, you're gonna pay for that. I mean, that's gotta come out of your pocket right now, okay? So you don't have, no, you don't have to actually buy it when that call,
No,
that's,
but like later down the road, if you actually wanted to sell it for the price of that, you would have to purchase the stock.
no, no, no. That's an option. That's why it's called an option.
I get what
You,
you're saying.
that's why it's called an option, because you have the option to buy it in the future at that price,
Yeah, I know.
but not the obligation.
I know you don't have an obligation to.
No. It's to buy the shares, you would,
You would anyways.
and it's
Yeah.
either that or it's either
That,
that or
that doesn't have anything to do with your call option, though.
Yeah, that's right. I
Okay.
was like, I didn't know like if you.
No,
right.
right. It gives you the option to buy it, but not the obligation to buy it. But, you know, if you let that go, then your call, your money that you spent for that call option just goes away.
How long do they usually, like how long does it take them to expire?
Maybe 6 months, a year, you know, different timeframes. Yeah, so, and you can, if you own stock, okay, you know, let's say I own 1,000 shares of Apple, I've never done this, and I don't know if my buddy that's in the stock business has ever done it, but I could say, I want to let my stock be used, because technically that stock has to be set aside, okay? I want to let my stock be used in that fashion, so if you're buying that call option, that money would come to me, right? But then technically, when that call option came and you wanted to exercise it, it's gonna take my stock then. I have to give up my stock at that point in time. If the option expires unused, you know, the stock doesn't go up, so the option, I get to keep the $140 or whatever you spent for the option then, right? Okay, so there has to be a party out there that's willing to say, "Yeah, I don't really, I own the stock, but I don't really think it's gonna go up that much, so I'm willing to put my make mine available for that." Oh, hell yeah, it's gambling. Like I say 80% of them, you know, 80% of them expire unused, meaning that you spend the money and you don't get any benefit from it, so yeah. Here's a good example. Gilbert, can you read that call? Yeah, yeah. You guys talked about the efficiency of market, you had that in your assignment, right? Most efficient for the US government, again, because they're highly rated. There are some corporations that are more highly rated, but we're talking about the market as a whole, so corporate securities, they run the gamut from junk bonds, anything below BBB, to, you know, investment grade, which is anything above BBB, right? Well, the decimal, this is a little bit funny, getting kind of low on time, but there, shoot, up until 20 years ago maybe, stocks were not traded in decimals, not like dollars, right? You couldn't bid $14.43 to buy a stock, okay? That was all done in fractions, and it was either quarters, eighths, sixteenths, or 30 seconds. And a 30-second was called a tick. Okay? Yeah, it was really odd. So stocks moved as ticks and not as decimals. They changed that. It hasn't been that long. And again, that probably goes back to that floor thing, you know, and doing it in that fashion. It was a little easier than saying, you know, I want to bid $14.43. You'd bid, you know, 14 and a quarter or 14 and 3/8, you know, whatever it was, right? Okay. And I think it was 30 seconds that it went to. It might have only been 16ths, but I think it was 30 seconds. So you guys did this. Regulations, right? Yeah, and you see 33 and 34 was depression. And so the Great Fall, and there was some security, things added in 75, and then Sarbanes-Oxley came around in 2002. It's come up a little bit again. I've heard Enron come up a little bit again with the FTX thing, because Enron was a huge debacle that the SEC was supposed to be regulating them and didn't do a great job. Securities Act, we kind of had this in law, so I'm not going to get into it a whole bunch. See if there's anything I wanted to get done here, so I want to show you the bond thing on FINRA, because it's kind of cool. let's go to FINRA. Same place, okay, if we go to there and get to the market data. But instead of hitting the equities, come over here and I hit bonds. Okay. And if I hit search, in this case, it doesn't show me a lot. I got to come down here to this advanced search. So let's just say I want to look at corporate bonds. Industry group, I don't care, so I'm going to just put all. Debt instrument, I don't really care, I'm going to put all. Convertible bonds, that's fine, yeah, we'll put all. Bond seniority, I don't really care, okay. Coupon type, I also don't care. Interest frequency, I don't care, okay. Maturity date, though, I might care, right? So let's say I want it to mature, I should have gone a full year, but we'll go January of 24 to 27, okay. Perpetual bonds, I don't really care. Ratings, though, here's where I get in, right? And they're a little different. Standard & Poor's is the one we're kind of used to. So investment grade, I think, under Moody's is from here on up to AAA. From here, I know it's BBB, right, up to AAA. Okay, and Trace, that's another rating system that I'm not familiar with. Call options, callable, I'll say include, okay. Then I come up here, so I know that looks a little bit confusing, but see if this shows up, and I got to agree to the terms. No data available, so I did something wrong. Doggone it. What did I do wrong? Bond, all, select bond seniority, maybe I got to hit all there, I'll say include those. Coupon, doesn't matter, interest rate, maturity date. Again, we'll go there and we'll go there, include. Getting next call, I don't care. Hopefully that'll do it, let's see. Ah, what am I doing wrong here? Not clicking on one of the things that I gotta click on. What the heck is that? I'm gonna get rid of that. Let me see what that does. Damn thing, ticking me off. Huh. At least it's keeping my other search stuff in there. Convertible. Fund, doesn't matter. Interest frequency, I don't care. Maturity date, well, I didn't do that last time. See, got those ratings, AAA to there, calls and options. They got them in alphabetical order, right? And it's kind of cool. So 3M, we'll just look at this top one, right? So its coupon rate when it issued was at 3%, okay? It matures in August 7th of 2025, so 2.5 years, roughly, something like that. And what that's saying is that my price, remember when we did bonds and pricing and whatnot? So because rates are higher than 3% right now, right? They're 4 or 5%, something like that. Well, I can tell you what they are. They're 4.3% for this 3M bond anyhow, right? So I'm going to pay less than, yeah, so I'm going to pay less than that $1,000 for that bond. I'm going to pay $966.40, right? And I'll get 3% until 2025, but then I'll get my full $1,000. I'll get a full $1,000 when that bond matures in 2025, right? Even though I'm paying $966 for it. So,
How come they don't stress bonds more than stocks?
why don't they stress?
Like growing up, it was all stocks, stocks, stocks.
Historically, stocks have had a better rate of return than bonds. Okay, historically, quite a bit better rate of return than bonds. Okay, now that said, I think rates are getting close to topping out. I think the market's kind of telling us that. So 2 years from now, I think rates are going to be lower than they are today. So if I bought a 10-year bond, again, I might buy a 10-year bond at $966.40, okay, versus 1,000. But if rates came down under this 3%, maybe they got down to 2%, all of a sudden that's going to be worth maybe $1,100, right? And so I would make money on that bond because yields have come down, the price of that bond's gonna go up, okay? So right now, I don't think bonds, and that's what happens in the bond market and whatnot, people tend to buy bonds at this rate, because rates are up a little bit elevated right now, okay? So, this 49 pages, right? So, I finally hit the right buttons and got it to come up, but there's 49 pages, you can kind of take a look through them, it's alphabetical. I'll show you, I'm pretty sure, I'll bet you I can find some Apple ones in here maybe. Amazon, why would Amazon need to borrow money, right? But they do. Amgen, did I go too far? 5, 4. Yeah, even Apple, right? They got $250 billion in cash roughly, but they're still borrowing money. Here's a deep discount one, right? Because they issued this at a rate of 0.55, getting back to, back in the day, could they borrow money at really cheap rates? Yes, they could, right? It matures 8/20 of 25. It would only cost me $905, right? Because until August 25th, I'm only going to get 0.5%, right, return. But then when I sell it, right, I'll still get 1,000, or when it matures, I'm sorry, Apple's going to send me $1,000, even though I only spent $905 on that, right? So there's some advantages there tax-wise, because I'm kind of deferring some income really then until a couple of years from now. So, and it's AA, it's AAA according to Moody's, but just AA plus, which is the next highest that you can get. So I've used up all your time. Sorry. Okay, there will be a quiz on Tuesday though. The last two things a little bit. So, but don't get too excited. It's not. If you've been here and paying attention, you should be okay. How's that? It's not going to be a real long quiz. It's not going to be 50 questions. It'll be 10 questions or 12 questions or something like that. Just to reward you guys for showing up and paying attention. That's all it is. How's that? Plus, I'll have some candy again.